All right, let's dive into something that's on almost every investor's mind, building a real, honest-to-goodness stream of passive income using dividend ETFs. I mean, we all love the idea of our investments paying us, right? But the road to getting there, well, it's absolutely filled with traps. So how do we actually do it the smart way?
It really is the ultimate financial dream, isn't it? The idea that you can earn money while you're sleeping or on vacation or just, living your life. It sounds so simple, almost effortless, and that right there is the huge appeal of dividend investing. But hiding behind that simple idea is a critical choice, and that choice makes all the difference in the world.
And that's exactly what this is all about. You can follow a path that leads to stable, growing income for years, maybe even decades to come. Or you can stumble into a super common trap that can actually cost you money. So today, we're going to build the framework for that smart path so you can sidestep all those expensive mistakes. Let's start at square one.
Okay, first, let's just make sure we're all on the same page. A dividend ETF isn't just one single stock. It's a collection, like a whole basket full of them. The fund does all the heavy lifting, picking the companies, managing the portfolio, and then it just passes their combined dividends right along to you. It's diversification and income all rolled into one nice package. But as we're about to find out, not all of these baskets are created equal.
And that leads us right into the single biggest mistake that new dividend investors make. They get sucked into what I call the high-yield trap, thinking that the biggest payout is automatically the best one. And look, it's an easy mistake to make, I get it, but boy can it be a costly one.
You see a number like this, a massive 10% yield, and your eyes just light up. I mean, of course they do. When most things are offering maybe 2 or 3%, this feels like you've discovered some kind of secret cheat code. But here's the thing. A yield this high is rarely a gift. It's a signal. And you have to stop and ask yourself, what is it trying to tell me?
This right here, this really gets to the heart of the whole thing. That seductive 10% yield might look amazing today, but what about next year or 5 years from now? The real goal here isn't just a quick score. It's about building an income stream that you can actually depend on for the long haul.
So, why is that high yield such a trap? Well, as this slide shows, it's usually a sign of a really shaky foundation. It can mean the companies inside the fund are in financial trouble, that their stock prices are actually falling, or even worse, they might be forced to cut that dividend you were counting on. Chasing that huge yield can lead you directly to the weakest companies out there.
So if chasing yield is the trap, then what's the smart move? It really requires a shift in how you think. Instead of focusing only on the income, we need to look at the whole picture. This is what we call the total return view.
Think of it like this. There are two types of investors. The yield chaser gets blinded by that big income number, and they risk their original investment just to get that juicy payout. But the total return investor, they're playing a totally different, smarter game. They know that real, sustainable wealth is built from two things: the income you get, plus the growth in the value of the thing you own. This is it. This is the simple, powerful formula that should guide every single one of your decisions. It's not just about what you get paid today. It's about the overall health and the growth of your investment. An ETF that can deliver on both of these fronts, that's where the real magic happens.
And this slide just makes the difference so clear. Look at ETF A. It went for that seductive high yield, but its underlying value dropped so much that it had a negative 2% total return. You actually lost money. Meanwhile, ETF B had a more modest yield, but it was built on solid, growing companies, and it ended up with a positive 10% total return. I mean, the choice is obvious. You want the one that actually builds your wealth.
Okay, so we know our goal is total return. Awesome. But how do we actually find the ETFs that can deliver that? Well, here's a practical checklist you can use to guide you.
First things first, costs. Every single ETF charges a fee, and it's called an expense ratio. Now you might see a low number like this, 0.06% versus say 0.35%, and think, what's the big deal? Well, let me tell you, over decades, that tiny little difference can mean tens of thousands of dollars more in your pocket instead of the fund managers.
Next up, you've got to look under the hood at diversification. A lot of those high-yield funds are dangerously packed into just one or two sectors, like energy or real estate. A really well-built fund spreads its bets across many different parts of the economy, just like you see here. This is what gives you the stability you need to ride out any economic storms.
And finally, you have to zoom out and think about the bigger economic picture. For instance, when interest rates go up, new super safe government bonds might start paying a decent income. This can tempt investors to sell their riskier dividend stocks to buy those safe bonds, which can push stock prices down. You don't have to be an economist, but just understanding these basic forces really helps you stay ahead of the game.
Finding the right ETF is a massive first step. But now, let's talk about the long-term strategies that turn a good investment into a true wealth-building machine.
This is the absolute magic of compounding, laid out right here. It's often called a DRIP, which stands for Dividend Reinvestment Plan. Instead of just taking the cash payout, you automatically use your dividends to buy more shares of the ETF. Then, those new shares earn their own dividends, and it creates this powerful snowball effect that can just dramatically speed up your growth over time. It's amazing.
And here is a pro tip that so many people overlook. Where you hold your dividend ETF really matters. See, in a tax-advantaged account like an IRA or a 401k, your dividends can grow and compound without you paying a tax bill on them every year. But in a regular taxable account, you lose a chunk of that income to taxes every single year, and that really slows down your snowball.
So let's just be perfectly clear about this. This strategy is not about getting rich tomorrow. It is about systematically building stability. It's about creating a reliable long-term cash flow machine. The real keys to success here aren't about finding some secret stock or trying to time the market. They are patience and discipline. That's it.
And look, if you take away just one single thing from all of this, please let it be this. Forget about the intense, high-risk chase for a quick score. Focus on building something sustainable, something resilient, something that can actually support you for the long run. That is the smart way.
So I'll leave you with this one question to think about. When you look at your own approach to investing, are you being drawn in by the seductive promise of a quick win? Or are you patiently building something that's truly designed to last? The choice, as always, is yours.